万座千秋，多少平凡的历史。The asset manager industry is at last sorting the cracks from the true specialist, argued John O. Sullivan. In March 1868, a prospect appeared for a kind of money market scheme. The foreign colonial government trust would invest 1 million in a section of bonds. For 85, a investor could buy one of 11,765 certificates given an equal share. The trust promised 7% yield. Its aim was to give the investor of moderate means the same advantage as the large capitalist in diminishing the risk of investing by spreading the investment over a number of different stocks. The modern asset management industry was born. A week later, The Economist ran a leading article broadly welcomed the new trust, but setting the tone for 150 years financial prodigy is quoted about the selected bonds. A chunk was allocated to Turkey and Egypt, countries that go on borrowing as long as they can. When they cease to borrow, they will also cease to pay interest. Fears was expressed that Europe was disintegrating. In lending to Italy, you lend to an incorrupt state. In lending to Austria, you lend to a deviant state. In both there is a danger. The trust was a brainchild of Phil Rose, a lawyer and financial advisor to Benjamin Darren. His idea was a pooled investment fund for the middle class caught on. In 1873, Robert Freeman, a Indian-based businessman, started his own investment trust, the first Scottish, modeled on a Rose fund but with a broader remit. It was largely invested in mortgage bonds of Royal Red List in New York. The holding was in dollars, no sterling, and whereas Rose Trust was a buy and hold vehicle, the trustees of the First Scottish reserved the right to add or drop security as they saw fit. Rose Trust survives to this day, but asset management is not a far bigger business. Over 100 trillion worth of assets inherited in poor investment managed by professors who charge fees. The industry is central to capitalism. Asset managers support jobs and growth by directing capital to businesses they judge to have the best prospects. The returns help ordinary savers to reach their financial goals, retirement, education, and so on. So, asset management also have a crucial social role, acting as a guardian of saving and the steward of swing saving are trusted to. It is a business unlike any other. Managers charge a fixed fee on the assets they manage, but the customers ultimately bear the full cost of investment that's so. Profit margins in asset management are higher by standards of other industries. For all the talk of pressure on fees, typical operating margins are well over 30%. Yet despite recent consolidation, asset management is a fragmented industry with no obvious exploration of market power by a few large firms and plenty of new entrants. Many industry firms avoid price competition by offering a product distinct from their rivals, or at least that appear distinctive. Breakfast cereal is mostly grain and sugar. The makers offer a proliferation of broadly cereals, with double variation on a theme. Asset management is not so different. Firms compete in marketing, in dreaming up new products, and above all, on their skills in selecting security that will rise in value. The industry has not performed well ever since a landmark paper by Michelle James in 1968. Countless studies have shown that the managers of the equity have failed to beat the market index. Arithmetic is against them. It is as impossible for all investors to have an above average return as for everyone to be of above average high or intelligence. In any year, some will do better than the index and some worse. Evidence of sustained outperformance is vanishingly rare. Where it exists, it suggests that bad performers stay bad. It is hard to find a positive link between high fees and performance. Quite the opposite. One study found that the worst performing funds charging the most. Why do investors put up with this? One explanation that investment funds are more complex than breakfast cereal. At best, they are an experienced good where quality can be judged only once consumed, and they also like college education or medical practice. Consider goods that buyers found hard to judge immediately. Even well-informed investors find it tricky to distinguish a good stock picker from a lucky one. Savers are keen to invest in the latest hot fund. The studies by Ariel Story and Peter Children in the 1990s show that once fund managers has gathered assets, those assets tend to be sticky. They are lost only slowly through bad performance. Firms have a federal duty to act in the best interest of customers. Securities regulators oversee asset management. Unlike banks, which borrow from depositors and the markets, asset managers are leveraged and so not subject to intensive rules. Assets belong to beneficial investors. They are not held on a firm balance sheet. The thrust of regulation is consumer protection from fraud and conflicts of interest. It does not precise investment strategy or fees. An investigation by FCC in 2016 found that investors make ill information choices, partly because charges are unclear. The problem of poor decision making is most acute for retail investors. Even some institutional investors, notably those in charge of small pension schemes, are not very swell. Around 30% of pension funds responding to a survey by FCA require no qualifications or experience for pension trustees. Investors are a long way from all-knowing programmer of tax financial theory. A paper in 2015 by Niccolo Galliano, Andrew Cyril, and Robert Sedgwick argued that fund managers act as money doctor. Many people have little idea how to invest, just as have little idea how to treat health problems. Lots of advice doctors give is genetic and self-serving, but pensions still value it. The many doctors are in a semi-hand-holding business. The job is to give people the confidence to get the investment risk. In asset managers and in medicines, manners and confidence are as important as in infancy. Just as many patients trust their doctor, do not want to go to a random doctor even if equally qualified. Investors trust their financial advisor and managers, says Measured and his co-author. This may explain why investors stick with mutual fund managers even in the face of only so-so performance. As long as assets price goes up, the rising tide lifts many boat in the asset management industry, including lots of leaky vessels. But the seas are getting rougher. For the past decade, investors have placed more capital with low-fee passive funds. The funds invest in the publicly listed stock or bonds are liquid, that is easy to buy or share. The most popular are index funds run by computers. They track benchmark stock and bond index. The industry bigger winner has index giant whose scale keep costs down and fee low. The two largest BlackRock and Vanguard has combined assets under manager of 13.5 trillion by the end of 2019. The loser was active manager trying to pick the best stocks. High fees has not disappeared. The boom in passive investor has brought its antithesis. Niche firms run by humans is thinly traded assets charging high fee. A growing share of assets allocated by big pension funds. Endorsement and the sovereign wealth fund is going into private trade assets such as private equity, property, infrastructure, and the virtual capital. What has squared this shift is a desperate search for higher returns. The management of prices is an industry for concrete rather than the business, but has its own big names. A contract of Wall Street firm Apollo, Blackstone, Carrier, and KKR has captured much of the growth in assets allocated to private markets. The shake-up offers matches over a lot to microeconomists. The investors who snap up certificates in Rose Trust was dissatisfied with 2% interest in the money markets. Today, investors would sell their grandmothers for such a year. Interest rates in part of the rich world are negative. In Germany and Switzerland, government bond yields are below zero across the curve from overnight to 30 years. Inflation is absent, so interest rates are likely to persist. The expected return on other assets, the yield on corporate bonds, earnings yield on equities, the retail or commercial property has accordingly been pulled down. The value of assets in general has been raised. The steady decline of long-term rates is a nightmare for pension funds because it increases its present value of future pension promises. Industry often blame the Federal Reserve and other central banks, but the interest rate has been falling steadily since 1980s. Their deeper focus at work. The real rate return in theory decided by balance of supply and demand for savings. The balance are shifting, creating a bonus for asset managers, where fees are based on asset value. The competing explanations for the saving gap. Demography is one. People are living longer. The average working life has not changed much. More money has been safely away for paid in retirement, as much of the saving take place in years of peaking earning in middle age. Branch in the size of major confirm has pushed the supply of saving up. Another factor, the growing of China and other high saving emerging markets. At the same time, demand for saving has fallen. When Robert Firmin set up his investment trust, enterprises like railway was capital intensive. Today, the value of firms lies more in idea than in fixed capital. Big companies are self-financing. Small ones need least capital to start and grow. The upshot is that make money is just more opportunity. Investors are responding by trying to keep fund managers' costs down and putting more money into private markets in hope of higher return in public markets. This response is reshaping the asset manager business. The special report will consider the locked for the industry and ask it means for the economy, for the stewardship of firms, for capital allocation, and for savers who pay their trust in the money doctor. Will examine whether China untapped market can be a source of renewed growth. A good place to start is with the force shaping the industry elite.